We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Avril in Singapore with Annabelle Droulers in Sydney.
Our top stories. Asian stocks climb after the Fed's preferred inflation gauge came in below expectations, reigniting rate cut bets.
Panama rejects Donald Trump's threat to reimpose U.S. control over the Panama Canal. That's after Trump says the Panama Canal is charging high transit fees on U.S. ships and alleged Chinese encroachment.
And China's bond bulls continue to pile in despite the PBOC's warning following a record-setting rally in sovereign debt. Taking a look at the market action this morning, if there's really one corporate story that we're tracking very closely, away really from what's happening in mainland China, although of course it is that China weakness in terms of what we see for the Japanese automakers that's having a big bearing. But Honda, Nissan, we do understand from local media that they're preparing or aiming to reach a final pact on their merger by June of this year. So we are just seeing most of these automakers moving to the upside. Nissan just falling back a little bit to trade flat right now, but certainly, as I said, a corporate story that we're tracking very closely. What exactly happens with these Japanese car makers and how exactly they're preparing to fend off what has been very stiff competition from what we see in the world's largest automaker market, and that is, of course, China. Taking a look at what else is happening in the session so far today, we do actually see Asian equities mostly moving to the upside so far in the session. We had the Fed's preferred inflation gauge coming out at the end of last week, and that basically told us that the disinflation trend is still intact. And so then that sets us up, of course, for rate cut bets, and those are continuing to build in markets. Off the back, you are as well seeing US futures pointing again to some modest gains. The US dollar is fairly steady. Singapore just coming online this morning. One of the stocks that we're tracking closely is Singpost. That stock is down nearly 10%. Its CEO has been fired on a whistleblowing report, so we'll get more details on that just ahead. But in terms of what else we're tracking, it's really just the lack of trading activity. If you take a look at the AVAT function, for instance, it will tell you that trading volumes are basically traders are already on their holiday breaks a few days early, because you are seeing them tracking low throughout the session. That dotted line is blue, is where we're heading throughout the day's trading. The darker blue there, the solid one above it, is where we'd typically be on a 3-week moving average basis. Even as I said, US stocks are moving, Asian stocks rather, moving a little bit higher, snapping what has been a 6-day losing streak. Another thing to check, of course, is the setup ahead of the open today for mainland markets, and Chinese equities, continuing to monitor those. They have been fairly range-bound, but certainly the big focus is what's happening in CGBs, and we are just continuing to track that 10-year yield below 1.8%, and the 1-year yield as well at a point that we haven't seen, Avril, in around, I think, 2 decades.
Yeah, since the global financial crisis, and the 1-year yield is continuing to slip. I think there's a preference for the short and shorter dated tenors amid the potential perceived risk of intervention on the longer end of things. But we're also keeping a close eye on a couple of things out of China. We have the NPC, the Standing Committee meeting that is still underway, and we're seeing from CCTV reports that the legislature will approve a value-added tax law, and it's proposing concessions to taxpayers. Meantime, we are in the window for the MLF. It's expected to be left unchanged at 2%. And also, we had local media reports saying that the Chinese premier, in the meantime, that they are looking at more support or opening up for foreign firms in the country. And he apparently said that during a visit to Zhejiang, where he also is said to have visited a chip maker. So that gives you a sense of the kind of industries and sectors that might be priorities for Chinese authorities. And speaking of which, we have Shenzhen Dobots. That's a robotics company that's set to begin trading in Hong Kong today. That's following on from a $100 million IPO, Belle.
Yeah, and Avril, I think just thinking about robotics more generally, I mean, it's certainly just another area where we're continuing to see China really building out a lot of dominance in this space, and possibly just another area of that advanced technology capabilities that comes as we continue to see those risks or those geopolitical tensions rising between the US and China. And certainly where else that's being felt this morning is over in South America, because we've seen Donald Trump, for instance, a month out from taking office, but already sending shockwaves around the world. His latest target is Panama. He's threatening to reimpose US control over the Panama Canal, claiming American vessels are being charged exorbitant fees.
The fees being charged by Panama are ridiculous, highly unfair, especially knowing the extraordinary generosity that has been bestowed to Panama, I say very foolishly, by the United States. This complete ripoff of our country will immediately stop. It's going to stop.
Meanwhile, Panamanian President Jose Raul Mulino fired back at Trump's attack, asserting that rules regarding the canal are non-negotiable.
Every square meter of the Panama Canal and its surroundings belongs to Panama and will continue to be. The sovereignty and the independence of our country are non-negotiable.
For more on this story, our news desk editor Jill Deesis joined us. And Jill, suffice to say, this perhaps wasn't a country or a place that we're expecting to see these tensions flaring between the US and China. But just talk to us about the nuances in this story, because there are a lot of them.
Yes, Belle. So what it seems like Trump is really getting at here, it's not just about what he calls these exorbitant fees that are charged by vessels, but he's also taking issue with what he's saying is this sort of encroachment of control by China and other places. This kind of seems to boil down to the fact that while the canal itself falls under the control of the Panamanian government, there's several ports on both sides of the canal, two of which are controlled by a Hong Kong-based company. So it does seem like what Trump is ultimately implying here is that, there are nations like China that, he says have, sort of outsized control or influence over Panama. I would actually also point out that certainly you've seen China's influence in South and Central America grow pretty substantially over the past several years. I believe it was in 2017 or so when Panama sort of severed diplomatic relationships with Taiwan, obviously in part because of China's contentions over that situation. So you do have some of those concerns about influence that kind of enter the picture here. All that being said, what Trump is saying that he'd want to do here, take control of the Panama Canal again, there's not really a mechanism for doing that. So it really kind of remains to be seen, how serious, an allegation this is, what actual, kinds of things that Trump is implying would happen here. But I mean, as we've seen elsewhere in the world, you have a lot of, political leaders who have, kind of run up against Trump over the last several weeks in particular, and that's kind of, had some reverberations around the world here. So kind of remains to be seen what Trump could do, once he does actually take power in January.
Yeah, and he's really wasting no time, Jill, in kind of upending the global world order. We've also seen how many politicians have been keen to whisper into Trump's ear. What is the sense of China's strategy in all this?
Well, I think when it comes to China, I mean, Xi Jinping certainly has experience dealing with Trump before. These are two leaders that have had meetings in the past. So China isn't, and the rest of the world aren't really entering another Trump administration being completely on the back foot or being completely caught off, guard here. So when it comes to China, I mean, certainly there's this expectation of, we saw obviously the U.S.-China trade war launch during, Trump's first term in office. These anti-China sentiments within Washington, D.C. in particular have really become kind of a bipartisan issue here. I mean, you did see the continuation of Trump-era tariffs during the Biden administration. You actually saw sort of a tightening of the screws in several, aspects, including over semiconductors and other advanced technologies. And so, you have to imagine that Beijing is very aware of the possibility that that could continue under another Trump administration. There's some efforts there to kind of, safeguard its own industries and build up its own industries, but then also, potentially to to actually reach out to Trump and the United States going forward. At this point, you've got a lot of leaders, China or, wherever have you, that understand that, that they still want to play ball with the United States. And that does mean kind of figuring out a way to manage Trump going forward, whether that means additional meetings or, other kind of, sweeteners and everything like that. We'll have to see, especially, once Trump actually enters the White House. But yeah, I mean, these leaders all recognize that, they have to work with Trump here.
All right, certainly a very complicated relationship. It seems to be evolving, but that was our news desk editor, Jill Deeser. So let's bring in Si Fu, China portfolio strategist at Goldman Sachs. Thanks so much for joining us this morning, and just want to touch on essentially what that story is telling us. Yes, it's the Panama Canal, and we're talking about sort of tensions between Beijing and Washington being felt in Central America. Maybe not so much expected, but what does that tell you then about the outlook ahead for Sino-US relations? And again, how is that going to really have a bearing on the outlook for equity markets in mainland China as well?
Yeah. Definitely, the U.S.-China relations is an important factor that will influence the equity market performance. We think for next year, there are two major factors. One is domestic policies. The other is definitely U.S.-China relations. Well, from the equity market perspective, so far, most of investors are focusing on tariff. So the trade relations is the key focus now. We have done some estimation, basically assuming a 20% tariff hike that we estimate will have 3% earnings drag to MSCI China and around 7% valuation compression. So that will definitely have some impact, but to some extent, we think domestic policy easing will offset some of the negative impact there. And also, we expect RMB to depreciate, also giving some buffer. But besides that, if we think about U.S.-China relations in general, we have a framework that to think the relations from four aspects. Trade is definitely one important aspect, but besides that, we are also thinking about technology tensions, capital market, as well as geopolitics. So we do not exclude any other restrictions or tensions in other areas, although the market focuses more on trade because for the trade tension, we have a certain period that the tension has already been low. But over the past few months, given Trump is taking the office, definitely people are focusing more and more on the trade tension. We introduced a barometer to measure how much the market has priced in the tension. For the trade tension, a few months ago, it was around 20. The number is from 0 to 100. 100 is peak level. A few months ago, it was 20. Now it's around 60. So definitely we can see the change. But if we look at the geopolitics, capital market tensions, it's already been high. Over the past years, it's already been around 7 to 90 level. So far, we think companies which are vulnerable to this risk, the market have already give discount in terms of valuation. So that's why from the current valuation level, we think even there's risk, the downside is much smaller than, say, 2 years ago or even earlier.
So trade, tech, geopolitics, capital markets, I mean, all of these things are interrelated and interconnected. But how much do you think the bad news for equities has already been priced in?
Yeah, if we look at the valuation of MSCI China, currently it's trading at 10 times PE. So if we look at over the past 3 years, given the China market has been declining, considering all the domestic macro challenges as well as external ones, so current valuation, if we compare with the historical average, we are close to 1 standard deviation below historical average already. And if we look at equity risk premium, it's also around 7% to 8%. That has already priced in some geopolitical risk, given the trade tension began since 2018. So many related companies, including tech-related companies, if we look at U.S. investors holding in them, it's already declined. So that's why if we look at the current valuation level, we think it can be well supported by fundamentals. We forecast earnings of MSCI China to be 7% next year and 10% in 2026. So considering a 10 times PE, the PEG ratio is only around 1 time. So if we compare the valuation across global markets, China is also the market with almost the lowest valuation among major markets. So that's why at the current valuation level, we do think the downside looks quite limited. But if considering potential tariff risk, currently we are factoring around 20% tariff hike. If say it's 60%, of course we don't think it's that likely. But if that's the case, of course we are still expecting around 10% valuation downside from the current level.
Right, so quite a lot of bad news already has been priced in. We'll have more with Si Fu, China portfolio strategist at Goldman Sachs. Still ahead, Japanese media says Honda and Nissan will reach a final agreement on their merger in June. Details next.
They have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that means there is panic mode inside Nissan.
Ghosn, former chairman and CEO of the Renault-Nissan-Mitsubishi alliance, on a potential merger between Nissan and Honda. And of course, as we've been tracking the developments in this potential merger, we're hearing that NHK is now reporting Honda and Nissan aiming to reach a final agreement on their planned merger in June. Our transport reporter, Nicholas Takahashi, joins us now from Tokyo. So, Nicholas, it sounds like we have a timeline of sorts. What else do we know?
Well, that's an important thing to know now. As you said, NHK said Honda and Nissan are slated to reach a pact agreement by June. NHK also reported that later this evening they're likely to hold board meetings and possibly a press conference afterwards. So now we've got a better idea of the timing, and hopefully this evening we get a better idea of what the deal might look like, how it might build out over the coming weeks and months. And this is a pretty important threshold because we've been seeing speculation swirl about whether the tie-up was going to happen at all, whether it'll lead to the formation of a holding company. And there was also this sort of mysterious presence of Honhai, the Taiwanese iPhone maker, known as Foxconn, sort of in the background with its sights set on Nissan. People familiar told us that Honhai is setting aside its interest as long as Honda and Nissan merger talks are unfolding. But we're getting a lot of details all at once, and that'll definitely be the case this afternoon as well.
Yeah, certainly a very fast developing story. So Nicholas, when you said that we're getting more of a sense of what the deal could look like, what shape are we thinking exactly, do you think?
Well, there were reports over the weekend that Honda and Nissan are discussing the possibility of utilizing the same factories, or in other words, sort of combining their production capacity. And that was early in the speculation that production capacity would be merged, and also to help reduce the cost of R&D. In the US and China, especially with the development of hybrids and EVs, Honda and Nissan already had a partnership along with Mitsubishi Motor, announced in March and then later expanded in August. That mostly involved software development, batteries, and EV tech. So this is in line with that as well. So not too much of a surprise, but as we see news unfold over the next couple hours, and especially leading up to that agreement in June, we're going to see more details about capital ties. To what extent the companies are going to merge, to what extent those brands are going to find a balance, and especially the formation of a holding company will have a big influence on, that balance and how they share decision-making authority.
Yeah, there are a lot of details that kind of need to be filled in between now and potentially June. I think it was Ghosn as well that said that their businesses are not quite complementary. But part of the reason why this merger would make sense is because of the overcapacity as well in China. To what extent are both sides struggling there?
Well, China's been, I guess you could call it a bloodbath for a lot of legacy car makers, not just Honda and Nissan, but Toyota, GM, almost any car brand you can name really, is struggling to compete with local competitors like BYD, Geely, NIO, who are rolling out wave after wave of EVs with sophisticated technology. Honda and Nissan have both announced plans to slash production and cut back jobs in China. And for the most part, in the global auto industry, China is the flashpoint between this new wave of EV brands, mainly in China, and sort of the status quo incumbents of the car making world. China's dominance is starting to bleed into Southeast Asia, but North America at the same time is a completely different story because there are tariffs forthcoming, possibly via the Trump administration, on imports from China, as well as Canada and Mexico. And that spells a lot of trouble on the horizon and hurdles moving forward for all car makers, not just China or Japan.
Yeah, big headwinds on both fronts, right? That's our transport reporter Nicholas Takahashi there. And just as we go to break here, taking a look at what's happening with the 10-year government bond yield, because it's actually dropping again. So last week it was that story that PBOC was maybe feeling a little bit uncomfortable with where the 10-year yield was heading, started to signal a level of discomfort. But traders are once again just building on those bets for further easing, maybe using those recent moves as well as an opportunity for buying. But we're just tracking that 10-year yield there, moving down below that 1.7% mark. We'll have plenty more ahead. This is Bloomberg.
You're watching the China Show, and we're looking at the early stages of trading, looking pretty positive. It's more or less tracking on from the positive mood, I think, following on from the US PCE data that came in lower than expected. But of course, this is a holiday season where trading volumes are a bit lower than usual this time in the session. Chip stocks are going to be a real focus given how there's speculation about Chinese authorities' support for the industry, the sector. Meantime, keeping an eye on dollar China as well, below the 730 level, Belle.
Yeah, as you said, it's really about that holiday thin trading, but we are snapping a 6-day losing streak. Some of the analyst actions we're tracking this morning, keeping a watch on SW Research. They've just initiated coverage of Leap Motor and also United Semi. Shandong Gold, another name we're watching here. That is one of the largest gold producers in China. But just flipping the board to take a look, you mentioned we're going to be tracking those China chip stocks. We actually have heard from Premier Li Cheng urging more innovation, infrastructure development in semiconductor and computing stocks. Already ahead of the open, you're seeing some modest upside. More ahead. This is Bloomberg.
Welcome back. You're watching the China Show, and we're counting down to the open of markets, looking slightly positive based on what futures are telling us. Of course, the Hang Seng already started the day on the front foot, about 0.6% higher. But really, Belle, this is a day where we are in the midst of thin trading given the holiday season. And of course, keeping a close watch on any potential support for the Chinese economy amid a string of sort of disappointments, and investors sort of bracing for next year and the potential threat of tariffs as Trump really makes his presence felt, Belle.
Yeah, and we've seen that presence being felt as far away as Panama this morning. We're seeing still those tensions between the US and China that are being felt in Central America today. But certainly where we're watching at the start of the day is what's happening with the CGBs, because you're continuing to track that 10-year yield there. It is just moving a little bit as we had the PBOC last week sort of signalling it wasn't too happy really with the trading action around this. We'll get more details on this just ahead. Equities-wise, we're fairly flat to start the week. You mentioned, of course, that we're waiting for more sort of stimulus measures or stimulus announcements from the government. The question, of course, is when do we get that? Do we need to wait until the MPC? If so, we're waiting really until March for that, so several weeks to go. But that's the state of play there with the CSI 300. Again, fairly steady so far in the session. Let's change on, take a look at what's happening in Hong Kong this morning, because we had actually seen it doing a little bit better in pre-market, and again, that's being reflected so far. The Hang Seng Tech, for instance, up 1.2% to start the day. That does sort of follow across from the Wall Street session, because at the end of last week we had the Fed's preferred inflation gauge coming out a little bit weaker than expected, and so telling us that the Fed rate cutting trajectory is still very much intact, and so traders, of course, very optimistic off that, and we are seeing some gains across the board today. One sector that is doing really well though, and sort of standing out, and this is again more on a policy support measure, but it's the chip names in particular, because we had Premier Li Qiang out over the weekend essentially saying that there should be more development for Chinese semiconductor, Chinese computing stocks as well. He's looking for more innovation, more infrastructure development in these areas. So SMIC, for instance, we already had those gains at the end of last week and extending again for another day. But that is the story there. Let's also take a look, as I said, what's happening with CGBs this morning, because the 10-year yield certainly on the move. We are just seeing those across the board and actually being led by what's happening at the front end of the curve. You can see that 1-year yield, again, at a level we have not seen, I think, really actually back to 2003 at this point, Avril.
Yeah, it's been an absolutely crazy rally that we've been seeing in Chinese bonds, particularly on the shorter end of things. These bond bulls in China, they can't be stopped, right? And investors are continuing to buy the dip even after China's PBOC warned of aggressive trading in the bond market to curb the bull run. For more, let's bring in our China correspondent, Min Lo. Min, do we have a sense of where bond yields might go from here? I guess lower is the path of least resistance.
Yeah, indeed, but it's actually quite mixed. We have bankers from Stanchart, for example, saying that yields could go down further to 1.5, 1.6% by the end of next year. But there are other economists expecting that yields could go back up to levels around 2.2% on the back of reflationary measures. So pretty mixed in the longer term, but at least in the short term, if you look at December, this month, we have seen yields pointing down every single day except for 4 days. And that's even after the PBOC came out to warn against aggressive trading. Then we saw yields climb for 2 days before investors again buying on the dip. You can see there the 10-year benchmark yield, I think it's at a record low. The 1-year yield as well breaking below that 1% psychological level. And some analysts are saying that that is pretty extreme, because some banks are buying deposits at 1.1%. These are money that are often used to then buy these bonds. So it's pretty extreme at the moment, and this shows us two things. One, markets are already pricing in potential rate cuts, and also number two, investors likely betting that the economy is perhaps going to be in a stagnation for the longer term, and that's of course going to put some pressure on the value of the yuan as well, which of course is already under downward pressure because of the dollar strength.
So, Min, in a lot of parts of the world, we've got people that are looking forward to sort of relaxing toward the year end, but certainly not in China, because we know policymakers are continuing to meet there even over the weekend. But what exactly are we expecting out of that NPC standing committee meeting that's ongoing?
Yeah, this is going on until the 25th of December, but it is a regular meeting. The NPC Standing Committee meets at least once every 2 months, and this time they're going through just reviewing various pieces of legislation. We're expecting that they will pass a legislation for value-added tax that will provide some concessions for various parties, including caretakers for the elderly and young children, including, for example, medical devices manufacturer, agriculture agricultural producers. They're also reviewing a few other pieces of legislation like the anti-unfair competition law, as well as measures to promote the private sector growth, for example. But we're not expecting any big pieces of policy announcements that could move markets. The last big one was the Central Economic Work Conference, and some analysts have said that we're likely to be in this sort of policy drought at least until potentially next March when the Parliament meets.
Well, that's a lot of waiting for investors. They're eager to see more support for markets as well. Min, thanks so much. China correspondent Min Lo in Hong Kong for us. And still with us is Si Fu, China portfolio strategist at Goldman Sachs. Si, great to have you back with us on the program. You mentioned earlier on that, the bottom sort of looks like it's been priced in, but what about the upside potential, and how dependent is this on the timing of stimulus? When might we potentially see this? Do we have to wait until Trump's inauguration or the NPC, or even until after tariffs are actually announced?
Yeah, if we look at next year's outlook, actually, besides the U.S.-China relation, and another important factor is domestic policies. So since September 24th, people generally agree that the policy tone is pretty clear, that the government introduced a more comprehensive package to ease the policies and support the consumption demand side. So what the equity market investors are focusing on is more on the fiscal side, especially on consumption, how much boost or stimulus we may expect. So far, the market is basically trading on announcements, all the policy announcements, and with some hope that all the policies will become effective and could boost consumption and the investor confidence. And looking into 2025, definitely we think what is more important is how much concrete measure we can get. The other thing is how effective it could be, especially people focusing on like consumption data, inflation data, whether it will show some improvements. That will be quite crucial for 2025. So far, if we look at the market, the valuation is already low, given the recent correction in October, that the market is pricing in some uncertainty from the U.S.-China relations. But at the current level, we do think there's some upside that can be driven by more policy easing and more fundamental improvements. So what we are looking forward to is, one, if we can see more concrete measure, especially on how to boost consumption, whether there could be more coupons or subsidies issued, besides the trade-in program is expected to continue. And other than that, people are also expect to see some fundamental improvement, both from the company side, also from the macro side, if we can see some improvement in inflation and also consumer confidence, that will be also helpful to the equity market performance.
What about some of the headwinds for stock markets? I mean, we've been seeing, I guess, competition in a way because of the preference for Chinese bonds. The yuan depreciation also another risk for stock markets. How closely are you watching at those factors? And I think as we're speaking, the yield on the 10-year is at a record low in China.
Yeah, if we look at the monetary policy, definitely it's on the easing side. So we are still expecting the interest rate to continue being cut for next year. The policy rate, and also we may also expect further RR cut. But I think for the equity investors, definitely people are focusing more on the fiscal policies rather than monetary policy. But what we come wrong, or what may give more pressure to the equity market, is if the effectiveness is proven to be weaker than expected, then the equity market investor may get more disappointed. So fundamental improvements is still very important for next year. Currently, we are focusing 70% earnings growth for MSCI China, 10% for CSI 300. Definitely, we need to have inflation improvements, consumption improvements to support that. So that is what we think would be needed to have a more sustainable rally in the equity market.
So you've just been recently to Hong Kong or mainland China. What was the top question that you were hearing, or the top of feedback that you got from clients as well on that trip?
Yeah, a lot of the discussion, of course, is on the potential tariff impact, which is not surprising. There's a lot of uncertainty. People are guessing how much the tariff could be. Our base case assumption is 20%. Some investors may expect 30 to 40% tariff hike, but definitely most investors do think 60% is unlikely, quite unlikely. So that is discussion around the potential tariff impact, how much it may have on valuation, on earnings, and of course, currency is another aspect that it may influence. If we are having higher level of tariff hike, then RMB may depreciate more, especially for China offshore listed companies that may cause a translation loss. So these are the discussion about U.S.-China relations. But domestically, people are also discussing about policies, especially property policies is one of the focus. And another thing is people also looking at on the consumption side, how much we can get. So these are the key questions we get so far.
Yeah, that's what I wanted to actually ask about the consumption front. Given the amount of uncertainty that we've got over the coming months, do you think this time next year the Chinese consumer is in better shape than it is today? And what exactly are you expecting there?
Yeah, we do think there are some necessary conditions for consumer confidence to be boosted. One is the property market stabilization. Our expectation is the property price could be stabilized later next year, so that may give some fundamental support to consumer. The other thing is we think if we look at household wealth, definitely over the past year, households have accumulated some excessive saving. So consumption power is not a big question, but it's more about confidence. So definitely if there's more policies, including improve like insurance, including healthcare coverage, including cutting some tax. This kind of like policies will also be helpful to boost consumer like appetite as well as confidence. So we do think besides subsidy provided, coupons provided, other policies that may reboost the confidence would also be important.
All right, that was Si Fu there, China portfolio strategist at Goldman Sachs, and it does sort of seem to come back to that same story, which is that China's economy really does need further stimulus, and there is still that expectation that's building for further easing that's coming into the market as well. And again, just going back to where that is being expressed so strongly is in the China bond space, and you're seeing that 10-year yield there moving lower, but tracking or hitting a level that we've actually never seen for this. And so last week we had the story, of course, of the PBOC pushing back on this and basically urging to investors, this is not a one-way bet, but it does seem like investors are continuing to pile in, again, on that expectation that we do see further rate cuts ahead. But that is the story there. We'll also take a look at some of the top global headlines. And the Taiwanese president, Lai Ching-te, is facing growing challenges to his leadership amid tussles between his ruling DPP and opposition parties. Members of the DPP on Friday piled furniture to block the entrance to the legislature in Taipei. That's even as opposition parties managed to push through new amendments, including a law that could make it more difficult for the Constitutional Court to strike down legislation. A German judge has ordered pre-trial detention for a man suspected of driving a car into a German Christmas market. The incident left 5 dead and dozens more injured. The 50-year-old man has been identified as a doctor of Saudi Arabian origin who works in the region. Authorities are investigating his potential motives, including earlier warnings from Saudi Arabia. UK Prime Minister Keir Starmer's pursuit of closer ties with China to boost the British economy is raising private questions from officials. Sources say President-elect Donald Trump's team, as well as European diplomats, are questioning his stance on China. Last month, Starmer became the first British Prime Minister to meet Chinese President Xi Jinping in 7 years.
And coming up, NIO looks to take on Porsche and Mercedes with its new $108,000 EV. We'll get the details next. This is Bloomberg.
Chinese EV maker NIO has launched its most expensive car to date, coming in at $108,000. The manufacturer is looking to take on Porsche and Mercedes with its latest offerings. Our transport reporter Daly is with us, and Danny, this is an interesting move, and we have seen that sort of shift to premiumization from a lot of different EV players, but NIO has faced challenges over the past 12 months. So do you think that this is going to be sort of a release that tips the scales in its favour?
I think this just builds more pressure on foreign auto brands and precisely the German luxury automakers, German brands who are struggling quite clearly in the China market, the world's biggest auto market. And as you said, we're seeing this release from NIO, its most expensive EV yet, a new luxury sedan, coming in around 108,000 US dollars or 766,000 renminbi. So it's a bold statement for them, but it really comes at a time where it itself has been struggling. But as we see with the Chinese upstarts, they're not afraid to continually push the boundaries with higher priced products, but also on top of that, some lower cost products as well. NIO is also branching out with a new budget brand, and that is itself designed to target more of the lower cost offerings that the German automakers have with like the Smart and the Mini brands. And so this could mean that we could have another EV for around 100,000 yuan. And so this is just potentially putting more pressure on some of the German brands who are already struggling.
Targeting different segments of the market and giving these German makers a run for their money. But how much confidence do you think NIO is showing about the new products? What does this mean in translation to sales?
Yeah, I mean, over the weekend, the founder of NIO, William Lee, says that the sales that it expects to garner in 2025, they expect to garner around 440,000 unit sales. So that's about a doubling of this year, and it'll be improved performance if they can get there. But clearly, with the sales being a bit more lackluster this year and continuing to report heavy losses, this is as much as they expand, their financials continue to be a little bit dire as they burn a lot more cash. They don't necessarily have the kind of cornerstone investors of some of the legacy brands such as its rivals Xiaopeng and Li Auto has. So clearly, this is a bit more of a pressure point for them on the finance side. But if they continue to expand with the luxury and the budget, and clearly they are kind of trying to build that momentum forward. So we just have to wait and see. But when you look at its share price over this year, it's going to close out the year around 50% lower year to date.
Yeah, the share prices have really taken a hit. Danny, thanks so much for sharing the latest with us. Bloomberg's EV supply chain reporter, Danny Lee. Some other corporate stories we're following. Singapore Post has fired its CEO and several other senior leaders after a whistleblowing report related to its international e-commerce logistics parcels business. It alleged several employees submitted information with the intent of avoiding contracted penalties with one of Singapore Post's largest customers. The firm says it'll pay a settlement to the unidentified customer. OpenAI has unveiled a new AI model that can perform more advanced human-like reasoning and solve complex problems. The O3 model will be released early next year, along with a smaller version called O3 Mini. The release ratchets up the competition with its rivals as other AI developers push ahead with increasingly advanced technology. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Some of the headlines that we're tracking this morning, and China says it's going to be taking all necessary measures to defend its national security and territorial integrity. That's after the US's decision to provide defense assistance and approved weapons sales to Taiwan. China's foreign ministry has called on Washington to stop what it called dangerous moves that undermine peace and stability in the Taiwan Strait. Hong Kong will roll out more innovative products and systems and increase cross-border cooperation to boost liquidity of the city's financial markets. That's according to its Financial Secretary Paul Chan, and his comments come after President Xi Jinping called on Hong Kong and Macau to better integrate into China's development plans. Taking a quick look at markets, 23 minutes into the session so far this morning, and if there's really one sector that's actually standing out so far, I mean, take a look at SMIC, for instance. That is another day of gains for the stock here, but the story around SMIC relates to what we're hearing from Premier Li Qiang over the weekend, who's essentially calling for more chip innovation, more infrastructure development as well. So we have seen that stock, again, as we said, SMIC the clear standout, but broadly Asian or Chinese chip makers are moving to the upside. That's actually a fourth day of gains for this name, Avril.
Yeah, and this is after already a double-digit rally at some point during Friday's session for SMIC. I think these chip stocks are really in focus given the strategic competition with the US. Is that going to mean more support for technological self-reliance within China? But of course, broadly, we're seeing in the sector performance today, I think infotech and materials, those are the top performers, along with consumer discretionary. And this kind of goes back to what one of our earlier guests were talking about, that support for consumption at a time where China consumers not willing to, splash out or spend big. Certainly today we're seeing some gains on the mainland as well as on the Hang Seng. Let's take a look at how the rest of Asia is faring. It is, of course, riding on a tailwind from last Friday. The US data stoking those bets of a Fed cut, 1% higher on the MSCI Asia Pacific. Of course, we also had some support as the US government averted a shutdown, so that propped up sentiment a little. We'll have a lot more on the way in the next hour. You're watching The China Show.
Welcome back. You're watching The China Show this morning, taking a look at how the CSI 300 is faring half an hour into the session. And actually, I mean, it's a pretty good start to the day, Avril. We had Asian equities just broadly snapping what's been a 6-day drop, but Chinese equities in particular gaining across the board here this morning. And there's also that question of more support coming through for the computing, for the semiconductor industries in particular. And we are seeing some good gains in the tech space.
Yeah, certainly. I think that is the sector that's outperforming today on a day where the focus is still on Chinese bonds. Take a look at how the 10, 30 years have been climbing, but where we're really seeing a lot of the gains are in the shorter end of things, 913 on the 1-year yield. And I think on the 10-year yield, you note how it is the lowest since 2005. I believe that's the lowest we've ever seen this. Just think, at the start of the year, this was sitting around 2.6%. So the expectations of monetary easing, the economic weakness, the fact that, we're not seeing certainty in the stock market, so investors piling into bonds, all factors that have been driving this rally. But let's also take a look at what we're seeing in the rest of the region, excluding China, because, of course, there is still that bit of reaction, even though maybe some of the moves we're seeing now is exacerbated by the thin liquidity, thin trading. But you're seeing upwards of 1% on the Kospi, on the Australian benchmark, TAIEX 2.6%. It looks like it's really a tech-led rally, investor confidence amid the US data that's making the case for the Fed to cut. Belle?
Yeah, and taking a look as well at some of the big data releases in the week ahead, because, of course, yes, the trading activity has been led by the PCE figures from Friday in the US, but still, there's a couple of highlights in Asia this week. CPI, for instance, PPI figures standing out in Singapore, Japan, Tokyo as well. That's a leading indicator for the nationwide reading. Trade figures, of course, in Thailand in the middle of the week. Jobs figures coming out, and industrial profits, the big one really perhaps to watch in China at the end of the week, given you kind of have seen those signals, again, going back to these expectations of easing. In terms of what we've seen so far for industrial profits, it tells us that maybe we've got a bottoming out of the economy, but there's still that expectation we get more stimulus to try and see a more sustained recovery in China.
Yeah, and it'll sort of give us the baseline that China is working with as we approach 2025 and the sort of tariffs and potential other strategic moves that we might see from the Trump administration. I mean, Belle, we've just been talking about this the whole of this morning about how they're threatening the Panama Canal now coming from Trump, those developments, which of course has received pushback. Let's bring in Yoon Liu, ASEAN economist at HSBC, for her thoughts on the broader picture. So, Yoon, we're seeing how Trump is really wasting no time, a lot of rhetoric here. But what is your sense of the baseline that China is kind of working with in 2025?
Well, thank you for having me. So I think for now, what I call uncertainty is the new certainty here. There's still a lot of things that we don't know. I mean, especially, as you mentioned, there's so much talk on tariffs, but we don't know exactly what kind of policies are on whom, to which sector, and it might involve rounds and rounds of negotiations. So for now, I think it's still too early to draw any implications. But I think it's also, worthwhile to look at some of the data, some of the facts here. I mean, ASEAN really has been emerging as one of the main beneficiaries since the U.S.-China trade tensions under Trump 1.0. And I mean, we're not only seeing, export diversion to the region, we're also seeing FDI diversion. So very much the market is waiting for clarity on potential tariff policies from the incoming U.S. administration.
What about, after years of pandemic spending, when you look at these ASEAN economies, which do you think will be perhaps better prepared or, have the ammunition to tackle headwinds?
Yeah, that's a very good question because, despite external risks we're seeing, I think it's also important to look within ASEAN. And actually, domestic resilience it matters a lot for ASEAN. There's still a lot of good momentum within each ASEAN's country's economy. And actually, one of the things that we'll look at here is really Budget 2025. I mean, in terms of that, policy support from the fiscal part, because really from the monetary part, given there's some currency concerns and also hawkish than expected Fed rate cut expectations. I think for the monetary angle here, the ammunition may not be as much as we thought. But really, I think on the fiscal front, the ASEAN policymakers really trying to strike a balance here between trying to have some fiscal consolidation, restoring fiscal prudence, but at the same time also introducing pro-growth policies. And we're not only talking about near-term, cyclical policies, geared towards consumers, but we're also talking about reviving the old playbook, which is infrastructure spending, which is really a perennial priority among policymakers in ASEAN.
So which economies in ASEAN do you think are sort of in better stead against this backdrop?
Well, I mean, again, I think it very much depends on where we talk about. It depends on what kind of policies we're going to see from the incoming U.S. administration. But I think it's important to look within ASEAN. I mean, especially given all this good momentum. Despite some uncertainty here in terms of trade recovery, we're seeing, Singapore, Malaysia, Vietnam really riding through this, especially the tech cycle here. And as well as I think that FDI relocation is also a very important theme within ASEAN. And especially, say, for countries like, Vietnam and Malaysia, these two really have have been improving its fundamentals and trade prospects. And we're still seeing consistent FDI inflows into the country. I think for FDI, it's quite important to realize that, a lot of the FDI decisions, we're talking about 3 to 5 years and even 10 years. So it really reflects the structural, it really reflects the long-term confidence of investors on the ASEAN economies here.
Yeah, we've certainly seen, as you said, really the efforts from Malaysia, Vietnam, for instance, to try and get more of that value chain of semiconductor development in particular. But when it comes to cooperation as well between different ASEAN countries, which ones are standing out to you?
Oh, definitely here. I mean, Singapore and Malaysia set a good example here. We're talking about the Johor Singapore Special Economic Zone, SEZ. We're still waiting for more details to be unveiled. But I think it's a good example of, in the face of uncertainty, cooperation between states, especially within ASEAN, is much needed. So for SEZ, I think the idea is just to, leverage each other, Malaysia and Singapore's comparative advantage. Malaysia, has abundant land, energy, workforce here, and then Singapore, has the technology and a lot of the skills here. So how to put everything together in one area and leverage on that strength and propel growth for both countries. I think we're very much looking forward to that announcement.
So the growth stories of certain Southeast Asian countries, which part do you think is going to constrain central banks the most? The outlook there for growth, or is it more around a Fed story and this expectation maybe we stay higher for longer?
Yeah, so I think for ASEAN, it's actually quite a mixed picture here. There are only two ASEAN economies where we expect rate cuts. We're talking about Indonesia and the Philippines in 2025. But even for these economies, we expect shallow rate cut cycles here. I mean, the Fed, hawkish and expected Fed rate cuts is definitely one concern here. The currency is definitely an important consideration. Also, say, for example, in other economies here, I think, some economies like Singapore here, we are also talking about elevated inflation and stickier than expected inflation. I think that's very much one consideration. For the rest of ASEAN countries, we do not expect them to ease anytime soon in 2025.
So it's really not synchronized kind of easing cycle that we're expecting out of the Southeast Asian region next year. But when we take into account the calculus for the Fed, I know this is not the base case at the moment, but what if the odds shift from a cut to a hike? What might that potentially mean for Southeast Asia's economies?
Well, I mean, I think then we will have quite a lot of implications for everyone around the world, for a lot of the central banks here. That's not our base case. For now, we still expect 3 rate cuts by the Fed next year. But I think that hawkish and expected rate cuts from the Fed, I mean, the rate cut expectations from the Fed really also has implications for the ASEAN countries. I mean, except, we're talking about Indonesia and the Philippines. Even for them, it will likely be shallow rate cut cycles. And I think for also other countries here, it will also constrain their pace in terms of monetary easing. So for the other 4 economies, we do not expect any rate cuts in 2025.
How soon do you think the likes of Indonesia and the Philippines will start their easing cycles? I think the BSP governor speaking to Bloomberg last week did say that they're open to starting the year with a cut. What is your sense of how things progress?
Yeah, I think that it very much also boils down to the data here. Currency is definitely one concern here. Inflation data is also one concern. So I think for these two central banks, having being data dependent and seeing how things evolve, I think is also quite important. So for them, it's mainly data dependent approach rather than outlook based outlook here.
Yoon, thank you so much for sharing your insights with us. 2025 is going to be really exciting. Yoon Liu, ASEAN economist at HSBC. Still ahead, a new wave of political fighting between Taiwan's political parties, adding to questions about President Lai Ching-te's ability to govern. That's next. This is Bloomberg.
Well, Taiwanese President Lai Ching-te is facing growing challenges to his leadership amid tussles between his ruling DPP and opposition parties. Bloomberg's Chen Hua-wan joins us now. And these were some pretty vibrant scenes, to say the least, really last week. But what exactly happened and how is it affecting the political landscape in Taiwan as well?
Well, we have to say that this is a very complicated and rare situation we're facing right now. So actually, they're trying to paralyze the constitutional court and also because they have the majority of the opposite party have the majority of the legislature, and they are changing the laws to make it basically harder for them to get callbacks, so they can actually seize onto whatever power they have right now and continue to cause some disruptions to the Lai government. And for what will happen after this, like first we can see that these amendments they passed last Friday, they won't take effect right away. They still need the cabinet and the president's approval, right? So before that, the government can still send the amendments for review in the constitutional court. So the grand justice still could make it suspended from actually taking effect. And second, that there are some lawyers among the people that are advocating that President Lai should get engaged with these conflicts and actually held a meeting to get the cabinet and the lawmakers to actually sit down and have a real conversation and actually discuss what the matters, the issues right now, and actually solve the problem. Yeah.
So Chenhua, I just want to go back to that vision we were just showing there. So that was the members of the DPP on Friday that were blocking the entrance to the legislature in Taipei. Opposition parties, they still managed to push through these new amendments. So can you just talk us through what those amendments were specifically, and also where does the Lai government go next? I mean, they are quite, as I said, colourful, but pretty violent scenes, really.
Yeah, so because they try to, the TPP lawmakers try to like block the lawmakers away from the meeting to actually happen, right? But they kind of I don't know how, I'm not sure how they break through, but I think they kind of destroyed some of the doors and the locks to get in and to make the meeting still occur again. And they actually used they abandoned the electric voting system. So they used like raising your hand to pass all the amendments, which is very wild, because how do you make sure that those countings was right? And okay, and back to the amendments. So basically they're making it harder to call back officials. That also means the lawmakers and the mayors in the counties, and also all sorts of elected officials to be recalled. So in this state that the KMT have the majority of the legislature, so they can still hold on to their powers. And the second that's more severe is the constitutional law. They're trying to paralyze it with the new amendments that will basically cause them to not review anything. They can't make any decisions, right?
All right, that was Bloomberg's Chenhua Wan there in Taipei. Thanks so much for your time this morning. And let's turn to South Korea, of course, where we've had a political turmoil as well. President Yoon's fall from grace is actually building support for his biggest political rival, that's Lee Jae-myung. Bloomberg's Yoo-kyung Lee joins us now from Seoul. And Yoo-kyung, Lee Jae-myung is someone, of course, who has his own legal challenges possibly ahead, but tell us more about him, and indeed if we do see the Constitutional Court approving the impeachment vote from last weekend, what exactly comes next for him as well?
So opposition party Lee Jae-myung has lost in 2022 presidential election to Yoon by the narrowest margin ever in South Korea's history of presidential elections. So, but he's the one with the biggest chance of becoming the South Korea's next president, as per the latest poll, which shows nearly 40% support rate for Lee Jae-myung, and the gap with the runner-up is really huge. His other rivals are showing less than 5%. 5% support rate. So by far, he's like the strongest contender to be the South Korea's next president. He's a former labor activist, and he has been compared to Bernie Sanders for his political vision and ideal, but his somewhat populist style has also drawn comparison to Donald Trump in the past. But he has his own legal challenges at the moment. So South Korean court has found him guilty of violating election laws. So he's waiting. He has appealed the decision, and he's waiting for the appellate court to come up with a ruling. And depending on whether the higher court upholds the conviction or not, he may be barred from running for the president or seeking office for the next 10 years. So for him, the speed of the Constitutional Court's ruling on the impeachment case is really important because depending on when the snap presidential election is called, he may or may not be able to run for the next presidential election.
All right, that was Bloomberg's Yoon Lee there in Seoul. Thanks so much for joining us, and we'll have plenty more ahead. This is Bloomberg. You're watching The China Show, taking a look at some of the big movers in the session so far this morning, and certainly, I mean, in an otherwise fairly quiet holiday-thin week. Of course, it's the corporate story in Japan that's standing out to us, and we had some local media reporting that the Honda-Nissan merger could be finalised, that pact, by June of this year. That could create a holding company to oversee both businesses. Clearly something that also speaks to the challenges that both of these companies are facing as well, particularly Nissan, that has been struggling with declining sales and profits. And actually on that, Carlos Ghosn, who's the architect, of course, of the Renault-Nissan alliance, says the merger talks between Nissan and Honda does suggest that Nissan is in panic mode. He told Bloomberg that while there are similarities between the firms, cooperation between them as well is going to be a challenge. Take a listen.
It's a desperate move. It's not a pragmatic deal because, frankly, the synergies between the two companies are difficult to find. There is practically no complementarity between the two companies. They are on the same markets. They have the same products. The brands are very, very similar. So in a certain way, from one side, Nissan, it's a desperate move to try to find the future. And from the other side, Honda, which, if I understand well, they were not very excited about this move. But, you know, you have to count with Meiji in Japan. That means the Meiji had a big say into it. So at the end of the day, they're trying to figure out something that could marry the short-term problems of Nissan and the long-term vision of Honda.
Do you think Nissan is being do you think Honda is being pushed into this deal by the economy ministry? There's politics pushing this deal, Carlos, rather than the value of the deal?
Without any doubt for me. That means having lived in Japan for so many years, I understand how influent can the Meiji be. And I can tell you that from all the data that I received about the performance of Nissan, which has been miserable for the last, at least for the last 2 to 3 years, they have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan.
You've dealt with the Japanese, you've dealt with Nissan, you understand the metrics to get these organizations together. Is the government going to have to deliver backstops to Honda to make this deal work?
No, I think they in a certain way tried to push Honda onto this deal. Obviously, Honda must have some kind of benefit out of it, if not on the short term, at least on the mid and the long term. But that will be closely monitored to make sure that the impact on the Japanese society is not going to be too big. Because, you know, when you have two companies of this size and practically in the same market with practically the same strengths and the same weaknesses, there are going to be a lot of costs to be taken out, and there are going to be a lot of duplication to be taken out. So this is going to be closely monitored by the Meiji.
It's driven by the Ministry of Economy. So there's a political dynamic to this. Is this Japan creating, putting two companies together to really try and stand up to the competition from China. Is that part of the narrative here, Carlos?
Without any doubt. It makes a lot of logic. Today, the Chinese automaker are on the winning side. They became, as you know, the largest exporter of cars. They are the largest maker of EV. They are being successful in a lot of new technology. They're doing fine cars. So in a certain way, yes, it's a defensive mood. It's a defensive mode that's going to be trying to shore up the Japanese industry and avoiding a cataclysm, first a social cataclysm in Japan, and particularly to try to reinforce these companies on the foreign markets.
That was the former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, Carlos Ghosn there. And checking how markets are performing so far, a couple of stocks really standing out. SMIC, this is, of course, the chip maker in China. You're seeing it up nearly 15% over the past 5 sessions. But we do see Premier Li Qiang urging more chip innovation and infrastructure development, boosting that. Over in Taiwan, actually, you're seeing Taiwanese stocks jumping, being led by TSMC. But there is a report in local media this morning saying that NVIDIA is looking to build out a new overseas headquarters in Taiwan. The Taiwanese government is also said to be assisting that effort. Again, as I said, Taiwan is leading Asian equities higher at the start of the week. More ahead. This is Bloomberg. Welcome back. It's 11:29 a.m. in Tokyo this morning. Japanese equities just about to go into their lunch break today. We do see a fair bit of green across the screen, but think about where we're sitting in global equities generally. We've got Asian ones that are snapping a 6-day decline. We've just had the Fed's preferred inflation gauge out on Friday. It told us that that disinflation trend still largely intact. That base case for a Fed rate cut reduction, again, still intact. As we are just seeing a bit of a steadiness coming through in the dollar. You're seeing it trading around 156 against the Japanese yen this morning as well. But broadly, as I said, Asian equities are looking a little bit high this morning. If you take a look at what's happening with the GMM function, seeing a fair bit of gains coming through in the tech space in particular, up 2.2% there. Sort of two different themes are playing out. You've got on the one hand this report that NVIDIA is looking to establish a new presence or a bigger presence with an Asian headquarters in Taiwan. That's local media reporting. That's boosting TSMC, for instance, this morning, the Taiwan gauge. The other story as well that we're tracking is China also issuing more development for the chip sector in general, and also looking to build out infrastructure as well around that ecosystem. And so you are just seeing tech stocks in mainland China as well moving higher. So that's the main theme sort of for equities this morning. But as I said, moving back to the Fed story and the expectations around easing that we're also feeding out, because we spoke with the San Francisco Fed President, Mary Daly. She said she's very comfortable with 2 rate cuts in 2025. She also told Bloomberg that Donald Trump's proposed policies are not going to be the factor that guides her forecasts.
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we are prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that there's 2 things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. but then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress is just slowed relative to what we had wanted, but that's a typical pattern. It's bumpy. As you get to the, from 2.5 or 2.8 to 2, it's just a bumpy path. Go ahead, please.
But at the same time, some people were wondering if there was this stickiness, and I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
That was the San Francisco Fed President Mary Daly there, and let's get more on that. The expectation for easing. Bring in our MLI strategist Mark Cranfield joining us. Also with us is our China correspondent Min Min Lo, because of course the other big story we're tracking this morning is what's happening in China bonds in particular. But Mark, I'll start with you. That reaction to what we just heard there from Mary Daly, who's saying that they could end up cutting less if inflation is sticky, but certainly it does seem like markets are trading off the expectation that easing is still largely in play for next year as well.
To some extent, I think we've got one rate cut priced into the curve for next year at the moment, but we've seen several times over the past couple of years where traders get ahead of themselves, either in terms of expecting too many hikes or too many cuts. I mean, that's not unusual at all. And it doesn't help, obviously, that the Federal Reserve is having to respond to something which they don't know 100% about yet. They're second guessing that there could be higher inflation next year because, America clearly doesn't need any tax cuts. The economy is doing very nicely as it is. So if you do throw that onto the top of an already very strong economy, then traders will assume that there is a serious risk of that embedding inflation further than it already is, and probably even pushing it up later in the year, which is partly why the yield curve is starting to steepen in the treasuries. And that's probably a theme which will persist certainly in the first part of next year. People will be reluctant to put too much money in the very long end of the yield curve when they think that the Federal Reserve is going to have to stand back and allow things to play out for a while. And typically we've seen in the past when the central bank is on hold and yet there are friction within the economy which is pushing up prices for people, that typically will mean you need a higher premium for bonds at the very long end. So more steepening is quite possible in the first part of next year. People won't stand in the way of that. In the meantime, people will have to wait and see more Fed speakers in the first part of the year, see how they respond to the first messages that come out of the White House after Donald Trump is put in place, because clearly what the Fed speakers have to say will be the way that traders interpret what they think about policy for the months ahead.
Okay, so one cut priced in right now. Yeah, that is a shift, I guess, after the data from Friday. But Min, let's also discuss what's happening in China's bond space this morning, because it's still, at least in China, that expectation there is that need for further easing next year.
Yeah, and that is pushing bond yields down to record lows on both the 1-year and the 10-year yield. I think it's now at about 1.7%. The 1-year still breaking below that 1% level. And some analysts are saying that that is pretty extreme, given that some banks are paying about 1.1% on deposits, money that is being used to buy these bonds. So you got to wonder at some point whether that yield will push back up toward that 1% level. But yes, it does show that investors are not only pricing in more rate cuts. There's also a lot of fears around uncertainty on how Beijing is going to respond to potential tariff threats, as well as the domestic headwinds there with the property crisis, the consumption crisis continuing on for a few years now. And so that bond yield is something we're watching very closely. Obviously, it puts more pressure on the yuan, despite the PBOC still, aggressively defending the value of the yuan. And we've heard this story again and again throughout the year. Investors really going head-to-head with the PBOC, pushing those bond yields down despite warnings from the PBOC.
Yeah, Mark, what do you make of what Minmin was just saying there, particularly in light as well? We had that yuan fix this morning, and again, a tight grip from the PBOC.
Yeah, they'll continue to do that for quite a while. And we've seen before that they can keep up this. People look at the gap between the traders' estimates and where the fixing is. It's above 1,000 pips at the moment, and it seems like a lot, seems like a very wide margin. And yet we've seen the central bank in China keep that up for several weeks at a time when they're very determined to maintain the value of their currency. They clearly don't want it to get out of hand. Right now, they're more interested really in trying to stabilize the equity market, trying to get people interested in that, get people focused on the fact that they're getting measures in place to try and boost the economy into next year, solve the housing problems, all those kind of issues. The last thing they would want right now is a currency getting out of hand and being too volatile. And that's one of the things which they are better at controlling than other parts of the security space. So they'll continue to do that. Also, they will be well aware that there may well be more tariffs put in place against China, which will affect the currency in the early part of next year. They won't want to get too far ahead of that because they know that the market, as soon as if the tariffs are put in place, the market will react immediately. Traders will immediately start to push down the value of the currency because they saw in 2018 that was a very successful trade. And traders like to repeat things that have done well in the past. So you can expect them to do the knee-jerk reactions the same in the early part of next year. So that's really what the PBOC is playing with. They want to keep that under control as much as they possibly can until they start to see a big improvement in the equity market and the economy. And then money will naturally come back to China at that stage, but that could be some months away. So in the meantime, it's going to be a difficult job, and you can fully expect that they will continue to manage the fixing every day in a very tight range in order to try and keep volatility as low as possible. But they can't stop the offshore yuan moving too much. And you've seen sometimes we get wide gaps between the offshore and the onshore. We may see that again in the first quarter of next year. We could see that spread get quite wide, even with the central bank pushing back against the daily fixing.
Yeah, I feel like there's a few ifs really when it comes to trying to tempt traders back into equities, but certainly we're seeing state support for certain sectors, and there's that continued focus on what's happening in the semiconductor industry, computing stocks generally. But Minmin, we heard from the Premier Li Qiang on this over the weekend.
Yeah, and the chip sector in general, it has been a pretty volatile morning today. I was looking at the stocks. United Nova Technologies, one of those companies that Premier Li had visited at the end of last week. That stock was trading up 2.1% this morning, but now it's down by about 1.2%. Perhaps it's the confidence being shaken by the news of NVIDIA expanding its production base nearby in Taiwan that is possibly shaking things up a little bit. But yes, Premier Li was in Zhejiang province at the end of last week, visiting chip manufacturers, a computing lab, urging for more innovation in this sector and more support for infrastructure. He said more support will be given to companies that want to spend more money in research to create new technologies that would drive new areas of growth in China. And take a look at that board. You can see pretty mixed. SMIC is trading up, but the others are in the red right now. And Premier Li also talked about the importance of supporting foreign-funded enterprises, saying China is still committed to opening up. So again, it's that story of China wanting to open its doors to the world. And this is amid that trade and tech war with the U.S., because the U.S. not only is restricting the sale of advanced semiconductors to China, it's also been looking to limit China's ability to sell legacy chips back to the U.S. as well. So clearly that focus around self-reliance is very important for China right now.
Mark, when it comes to self-reliance in China, obviously there's a lot of state support for China's semiconductor and broader tech industry, but at the same time it faces headwinds from the US and also just being further behind peers like Taiwan, for instance. Do you think that the tech sector is going to be an investor favorite in 2025, or do you think people still sort of stay away?
I'm sure they can do a lot more to promote that area. And as Mim was saying, there's a lot of local companies here which are doing clever things there to try and entice people. We've seen Tencent just recently announce things which is boosting the markets there as well. But it's really the consumer sector, which is the biggest worry for international investors, appears to be that China needs to really kickstart much more demand out of the consumer sector and put in place more measures to get people actually spending at home and not saving. That's been the big influence since the pandemic period, especially, is that Chinese people are putting a lot more money into their personal savings. They look at the property market; it's too dangerous for them. They don't like look at the stock market too much, and so that fear factor is keeping too much money into short-term savings. That's helping as well to push yields down as well. They need to get that money out, people spending it out in the economy, doing other things with their savings than just letting it sit there idly. And that's really, the government itself probably has to come up with some more measures to try and stimulate that as well. It will certainly help when you get innovative companies bringing out ideas that would entice people. But yes, it also needs to be a concerted effort from all the authorities as well.
That was our MLive strategist Mark Cranfield there in Singapore and our China correspondent Min Min Lo in Hong Kong. And just continuing to track, of course, what's happening in the Japanese automaker market this morning as well, because we did have reporting out on the possible tie-up between Honda and Nissan. What we're hearing now, again from local media NHK, is that Honda will pick the president of the holding company. So again, reiterating that the president of the holding company under which Nissan and Honda are set to merge is going to be chosen from among directors that are nominated by Honda, and that's what the Japanese public broadcaster NHK is reporting, but they're citing an unidentified person. So we'll have more details on that just ahead. This is Bloomberg. Welcome back. Some of the top corporate stories that we're tracking today. In Singapore Post has fired its CEO and several other senior leaders after a whistleblowing report related to its international e-commerce logistics parcels business. It alleged several employees submitted information with the intent of avoiding contracted penalties with one of Singapore Post's largest customers. The firm says it will pay a settlement to the unidentified customer. OpenAI has unveiled a new AI model that can perform more advanced human-like reasoning and solve complex problems. The O3 model will be released early next year, along with a smaller version called the O3 Mini. The release ratchets up the competition with its rivals as other AI developers push ahead with the increasingly advanced technology. And certainly when you take a look at the AI theme over 2024, I mean, we're sort of like 2 years post the release of ChatGPT, and certainly it doesn't really show any signs of slowing down. What we've heard from companies like NVIDIA, others that are closely associated with the AI ecosystem, that the demand is strong and it is intact, and that the use case of AI are continuing to broaden out. So 2024 is a year sort of led by the server maker SMCI, that supermicro computer. It faced some possible sort of accounting challenges early in the year. We saw that stock slump, has recovered somewhat of late, but generally NVIDIA has been the name to track. That's the line in blue. And then Vista, just another big gainer out of the past 12 months as well. But another company that we know that it's making or looking to make a big bet on AI is SoftBank. And part of that has to do with the company investing $100 billion in the US. And that was, of course, the big announcement that we had last week where Masayoshi Son was in the US. That is the focus of our big take today. Our editor, Mayumi Nageshi, joins us now. And Mayumi, talk to us about this big bet. We know that Masayoshi Son has been trying to do this for a while now, but what's the rationale for it, and how likely is it to pay off? He doesn't always have such a great track record, at least of late, of making successful bets either.
Well, Masayoshi Son is here back in earnest and trying to really cement his legacy. SoftBank was an early investor in NVIDIA. They sold their stake in 2019, and since then, Masayoshi Son has had to sit back and watch NVIDIA become the undisputed leader in AI. This is something that Son has been advocating, championing for over a decade. So it really is spurring him to show what he can do to contribute to this AI revolution. And he sees this huge opportunity in AI hardware, and he sees his 90% stake in ARM as the key to kind of bringing SoftBank out into the center stage in this push. They plan to get a prototype AI accelerator chip this summer, as early as this summer, and ready for shipment next year. This is there's still a lot of discussion ongoing. We hear our reporters are hearing about big sums getting thrown around, $100 billion during Son's visit to Mar-a-Lago with Trump. Trump joked, well, maybe you can invest $200 billion in America, and Son said, I will really try. And I don't think he was kidding there.
What's the likelihood of this sort of bet succeeding, though? I mean, you think about AMD, for instance, that's been trying to close the gap with NVIDIA, led by Lisa Su, and they've made some ground, but there's still a long gap between AMD and NVIDIA in this space. Can SoftBank really make a big impact here? And again, going back to sort of the issues that we've seen in investments broadly around the Vision Fund, do you think this time is different?
I do think this time is different in that we do have a much more chastised Son, and he is delving into an arena where he doesn't have a whole lot of experience. Chip manufacturing is in a league of itself. It's sort of an intersection of chemistry, optical engineering, and craftsmanship, born out of years of experience. And he's sort of forced to listen and engage in dialogue with his engineers, most notably with Rene Haas, CEO of ARM. But as you say, a healthy dose of skepticism is warranted here. This is something that AMD has tried, and still it's been very hard to close the gap with NVIDIA. NVIDIA itself, I mean, if you look at Jensen Huang and Masayoshi Son, they shared the stage recently in Tokyo, and Jensen Huang isn't worried. He knows how grave the challenges are ahead of anyone who wants to challenge NVIDIA. NVIDIA itself almost went bankrupt multiple times in this path, and it's a very, very steep uphill climb.
So, and given that, I mean, just talking about sort of the financing, because again, going back to when Masayoshi Son was in the US last week, we were sort of talking about, it was unclear how they were planning to fund this at least $100 million commitment, or $100 billion, but how exactly would SoftBank go about financing this? Because we heard from the CFO, for instance, in the big take today, saying that, that they had a lot of levers that they could pull, but what are they exactly?
Well, one of the things that we've been hearing, they do have many levers. They do have a sturdy cash pile of $25 billion. They have stake in ARM. They have 90% of ARM. They can sell off 40% of that and still control ARM. They have. We've heard. Reporters have heard about possible something like project financing, where they would get outside investors and sort of leverage, $10 billion into $100 billion. A lot of ideas are being floated in the financing. We have heard that the financing is likely to come after the other details in this chip plan are ironed out. So a lot of discussion and a big amount of money is getting thrown and like spaghetti on the on the wall.
All right, that was our tech editor, Mayumi Nageshi there, and you can read the full story in today's Big Take on the terminal or by heading over to Bloomberg.com. More ahead. This is Bloomberg. Well, it's holiday thin trading, but there's still some stocks that are standing out to us. And of course, you can see here, Shinsegae has been surging throughout the session so far. It's peeled back a little bit, but it was earlier up as much as 26%, or at least Shinsegae International now trading 2% high. But there was local media reporting that the group's chairman met Donald Trump in Mar-a-Lago. Broadly, though, in the session, the gains are very much being led by what's happening in Taiwan. Local media also says that Nvidia could be looking to establish an Asian presence there. The Taiwanese government also said to be assisting with that effort.